Hi, I'm Jimmy. In this video, we're looking at when interest rates fall, do stock prices actually go up? Now, we might have seen headlines along these lines, and we know that the Federal Reserve is talking about dropping interest rates, but what will that ultimately do to the stock market? Well, lower interest rates should, in fact, increase stock prices. Just to illustrate, we're going to jump over to the Investors Grow website and we'll pull up a quick example. And basically, what we're trying to do is we're trying to take discounted cash flow, discount it back to today. Well, one of the key factors there is the required rate of return. So, if we were to zoom in a bit and we were to increase the required rate of return, well, we can see that the fair value of this example stock the fair value goes down. And if you decrease it, well, the fair value goes up. So, in theory, that kind of makes a lot of sense. If you think about it, if you want a higher return, try to pay a lower price. If you want a smaller return, you could pay a higher price. So let's take a quick look at history to see if a decreasing of the Fed funds rate actually makes the stock market in general go higher. So the Fed funds rate is directly correlated to our required rate of return, or at least it should be. Now, if we were to use a textbook formula for how to calculate our own required rate of return, the formula would look something like this. Well, by the way, I did a video on this. If you're curious, I'll leave a link in the description below. But basically, in order to come up with our required rate of return, one of the components of that is the risk-free rate. Oftentimes, usually not the Fed funds rate, but certainly interest rates correlated with it, generally it would be something like the 10-year Treasury. Now, the reason that this is important and the reason that I would advise against just setting a hard required rate of return, let's say, I'm going to do 12% no matter what. Well, if you look at history, it really doesn't make a ton of sense to set a fixed rate like that. For example, if we were investing back in this time period, why would we want the same why would we want the same return as if we invested in this time period? If we go back to the early 1980s, well, we could buy US Treasuries and pick up double-digit returns. Why would we set our own required rate of return at 12% when we could get a 14% 30-year bond? It almost doesn't make any sense, which is why guys like Warren Buffett tend to set a premium over something. So if we go back and read some of Buffett's letters back when he ran Buffett Partnership, well, he set his required rate of return as a premium over AAA corporate bonds. So AAA corporate bonds might be 5%. He adds a 5% premium, required rate of return, 10%. Although there's lots of different ways to come up with the best required rate of return, and many times it depends on each individual. But with that being said, and that's kind of as a backdrop, lower interest rates should lead to lower required rate of return. And because of that, well, the stock market should in fact move higher. Well, with that in mind, let's look back at history to see if this is in fact true. Okay, our first time period is back in 1974, where they dropped interest rates from about 13% down to about a little over 5%. Now, this happened back at the time they were having stagflation, which is higher inflation and rising unemployment. So it's a real issue it's a real problem, because generally you would increase interest rates to offset inflation, but you decrease them to improve unemployment. With that in mind, we jump forward to 1980. Well, in 1980, Paul Volcker had become the Fed chairman back in 1979, and he really got strict. He really jacked up interest rates, tried to get inflation under control, and he did a lot to try to pull things back. But then the economy began to struggle, so they had to decrease it. And you could see here, the drop was a massive decrease in interest rates. We're going to get to how the stock market returned during all of these at the end. I just want to give you a quick outline of what happened during the different time periods. Okay, then we jump over to 1984. 1984, here they were trying to kind of spur along growth, being careful not to ramp up inflation again. So they decreased interest rates a bit more gradually. It took a bit longer of a time period to get to the level that they wanted. But basically, it's very similar to today's situation, where it was trying to spur growth, keep things moving, but without re-triggering inflation. Then we jump forward to 1987. This is when Black Monday happened. October 19th, 1987, Black Monday happened. The Dow Jones Industrial Average dropped 22% in a single day. The Fed, as a response to this, reacted by decreasing interest rates, trying to ward off a recession. Then we fast forward a couple of years, and once again, they were trying to spur along growth. The 1980s in general were they were fighting inflation, trying to spur growth. That continued in 1989 as they decreased interest rates to try to help push the economy along and again, try to stay away from inflation. We can see this one lasted multiple years, went on all the way into the early 90s. And then when we fast forward a couple of years after that, 1995, once again, they decreased interest rates a bit, trying to spur along growth and still stay away from inflation. There hadn't been inflation nearly as bad as it was back in the early 80s since that happened, up until 2020, of course. Then we jump over to 2001. 2001, tech bubble burst. They decreased interest rates, trying to stave off a recession once again. This is another one of those emergency ones. Again, fast forward a couple of years, the emergencies continue. Now we hit the financial crisis of 2007. And again, financial crisis started to hit. They started decreasing interest rates to try to fight things off, to try to, prevent a recession. They didn't do it, but they did drop interest rates a ton, all the way down to 0.25% here. Well, now fast forward once again. Now we land in 2019. They had started decreasing interest rates leading into COVID, but we can see with this big jump at the big drop at the end there, that's when COVID actually happened. They had started decreasing interest rates, try to, spur along a little bit of growth in the economy, but then COVID happened and they really had to drop it. Okay, now let's jump forward and see how the stock market actually performed during these individual time periods. So this is a chart that tracks the returns from the day they started increasing interest rates to the last day that they stopped. We just took that one time period. Now, as you may have noticed above my head, it's different times for each period. But I think one of the important things to notice here is that there's a few years that are down, few periods that are down, and a few periods that are up. But interestingly, all of the ones that were down happened because of an emergency trigger. So some event happened, Black Monday happened, and they had to quickly drop interest rates, and the stock market during that drop declined. Now, if we're curious, the average return during this time period is up about 6%. Now we're going to tack on 1 year at the end of the time period. So they started decreasing interest rates. Once they stop, we add a year to it. But when we do that, the numbers begin to look drastically different. So again, we do have the emergency years, but now some of them started to recover quite quickly. In fact, the average return during this entire time period is up about 35%. But from how this relates to today's perspective, when we were going through the different time periods in history where they had to decrease interest rates, or where they did decrease interest rates to try to spur along the economy, specifically 1984, 1989, 1995. Well, each of those, in my mind, are very similar to the situation we find ourselves in today. They're not decreasing interest rates for an emergency. They're doing it trying to spur things along, but also stay away from inflation. That was exactly the reasons, some of the reasons that they had decreased interest rates at those times. And interestingly, those time periods, assuming you held on long enough, those were fantastic returns. Now, what about if we were to look at this from the day that they started to decrease interest rates forward 1 year? Forget how long they decreased interest rates for. Just when they started, hold it for a year. So in theory, if they decrease interest rates in September, a year from there, what are the average returns? Well, this is what they would have looked like in history. And again, just to note the emergency drops that we've had in history, some of the recent ones. Well, the average return during this time period, again, hasn't been all that bad, up about 11%. Now, of course, if we were to go out plus 3 years, plus 5 years, the numbers start looking ridiculous and everything starts looking like it's doing quite well. So that's the reason I didn't go out that far. But I think the real conclusion here is if our investment horizon is long enough, decreasing interest rates should in fact be a positive sign for the broader economy. Lower interest rates should lead to lower mortgages, should lead to more robust spending, more robust lending by banks. Overall, it should be fairly good for the US stock market and probably the global stock market as well. Now, if you'd like to sign up to get access to the Investors Grow website, I will leave a link in the description below. If you're curious how to analyze individual stocks, I'll leave a link right here in the description below as well for that video. Thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.